Hello, folks. Welcome to Pro Trader Strategies. We are an educational company, so if you want an edge, you should start with this education. So hit that subscribe button and make sure you get a notification there so that you get a heads up when we are going live. Yes, we are doing scheduled videos every day at 11:30 Eastern time, and I do videos on Thursdays where I really talk about option strategies. Those are detailed webinars, but I'm also going to pop in and out throughout the day if I find an option strategy that I can implement in and around the markets at any given time. So if you want a notification of that, make sure you hit that and comment over at the side. Throughout this video, I want to make sure everybody is going to be clear a concept before moving forward. So if you want something to talk about or you want me to discuss something, throw it over there. I'll talk about it. And finally, smash that like button. It really does help us out. All right, let's get on with it. I'm Eric Wilkinson, and we got some economic data to go over. Across the pond, really not a whole lot, but today here in the United States, we got core durable goods orders. All right, now keep in mind, this is going to be anything that really a manufacturer produces that is going to last more than like 3 years. Okay, so these are going to be longer duration. The durable goods are manufactured products that are going to be around for more than a couple of years. So that number coming in at 0.3%, expected to be 0.8, so missing on that headline number. The one that really missed is the durable goods orders, and that is really missing on that headline number, coming in at 0.8%, expected to be 2.1%. A revision to last month's number, albeit slightly, they did revise it up to 3.2% from the original. It was right around 2.3%. So revised up by 1%, but keep in mind that does not make up for that headline miss on durable goods. That's the catalyst that really started the equity markets selling off this morning. Despite the fact that we did get some better than expected data later on in the morning, we got the Richmond Fed manufacturing coming in at 27, expected to be 20. So that is a huge beat there. And the consumer confidence coming in at 129, expected to be 123. Anything above 100 is good, and this is knocking it out of the park. Revision of last month's number up also by better than 1.5 points. All right, and that's about it for the economic data. Overall markets, we're seeing some weakness here. You can see in crude oil, if I remember to share my screen, there we go. We got crude oil coming off just a little bit. Now remember, if the manufacturing sector starts pulling back again, we should see some of this demand for crude oil start to come off, because the major driver in the demand aspect of crude oil is the manufacturing sector. Now we saw Richmond manufacturing coming in better than expected. Some of the PMI numbers better than expected. So I'm expecting the oil to hold on in and around mid 60s, maybe mid to lower 60s here. I don't think the demand is enough to drive it up there where some people are talking 80, 90, even $100 a barrel. I don't think we have that kind of demand right now. Another thing that we're starting to hear is everybody's starting to talk about this equity market not going anywhere for the rest of the year. Well, I've been saying that for about 3 or 4 months now. We are going to see some oscillation back and forth, a little bit of volatility, especially within names. Now that we're heading into this earnings season, we're starting to see that come to fruition. I said, I think we're going to see better earnings here, but their forward guidance is not going to be what we're used to. And a lot of these folks are coming out and saying, hey, we're doing very well. We're pivoting. We've expanded into different areas. Well, but we don't have a whole lot of forward guidance. And we're going to talk about a stock that I'm taking advantage of that type of miscue during their earnings today a little bit later on. But let's talk about the overall markets here. Bonds moving higher. That's by a full point at this time. Bitcoin coming off a little bit. Yesterday was a massive rally. Remember, we talked about Amazon talking about possibly using Bitcoin in the commerce of Amazon. Now, it's not written in stone. As a matter of fact, it was a lot of rumors yesterday, but that gave a little bit of credence to Bitcoin yesterday. Some follow through, maybe expected today, but I think the most important thing to look at is keep your eyes on Bitcoin running around 26 to 24. There's a gap there in the markets that we're going to be looking to cover down here. Now, I don't think we are out of the woods yet from covering that gap. It might be a little bit slower trudge after Amazon's announcement, but a clean cover of that gap would really get most technicians off of this bearish move here, but it's so close right now. I think everybody is kind of looking for that gap to get covered there at this point. Gold futures unchanged for the most part at the end of the day. VIX starting to spike back into the 20s right now, and that's because equities are just almost not having any support whatsoever. If I break this down into a 15-minute chart, you can see there's really no green candles. There's the economic data that we talked about that came out earlier this morning. That weakness is going to trump just about anything else. The durable goods orders is something that we are seeing. That's solid. You know, we talk about PMI being forward looking. Well, durable goods is not forward looking so much, but the fact that we were expecting a better turnaround in these durable goods orders and didn't get it, that's a bit of a wet blanket. But you can see the overall market's just seeing some weakness and down ticking as we go. Dow Jones Industrial Average off by about 200 points. People are going to try and put some money to work here in some of these blue chips that are going to try to be retainers of values. We talked about this in the past. The Dow Jones, a lot of the stocks in the Dow Jones have been lagging a bit. The NASDAQ has been driven by most of the big FANG names. A lot of the stocks in the NASDAQ actually aren't, doing as well as those ones that are really a heavy weighting in that index. Now, keep in mind, not every stock is created equally in these indexes. Some have much more weighting, and that's really what's been driving the NASDAQ to the upside. Now, if we're taking a snapshot at the E-mini S&Ps right now, something to keep an eye on. You guys hear me talking about chart setups, candlesticks, and everything else. Well, right now, if we were to take a snapshot of this chart, it would look pretty darn bearish. As a matter of fact, it would be considered a top for most technicians. We're looking at the setup pattern right there. That's yesterday's candle. Today, the confirmation. We were talking about this in the webinar yesterday. Anytime you get those candlesticks at the top of a move, right now we've got this hangman doji at the top of a move, and today it is, being confirmed, a settlement basically below the wick there. I'm just happening to draw this in on the Fibonacci, so I don't want to confuse you there. But, for the most part, this is what we've got, and that is a top. So I'm looking for this market to roll over. First line to test is the 4,285, let's call it, because that lines up with our Fibonacci extensions there of the 150. So topping pattern. If we were to snap out of this, even a finish near the high of the day, these charts are going to look very toppy, because in that case, I'm going to be having a chart where I've got the hangman doji here at the top, even in the E-mini S&Ps. And if it were to rally, let's say it rallies up near the highs, it could even turn into a green candle or whatever, but we could look at it being something like that. That's still signaling some topish, not confirmed at that point if we get that kind of rally at the end of the day, but that would be something that you would be looking for to maybe add some protection if volatility hasn't spiked too much by that point in time. E-mini S&P is very similar to that NASDAQ chart that we were just looking at. As soon as we got the economic data, we started seeing that weakness and really not seeing, there we go, got a highlighter on or something. That weakness showing up immediately off of those durable good orders. That's going to trump Richmond Fed Index, okay, any of those kind of numbers, the consumer confidence. That consumer can be confident and still not buy, folks. So that's one of the things we used to say on the floor. The consumer doesn't give you a great inclination of forward guidance when they're talking about being confident and everything else. We would assume that if they're confident, the beauty in that number is that we assume that they're confident that they are going to spend. When they're not confident, they have a tendency to not spend. So we're seeing more and more confidence. That is expectations of future spending. Okay, it's not confirmed though at this point. Apple, confirmation of the top. We've talked about this in the past, where we were looking at that tweezer top in Apple. I think I was even talking about this just yesterday. So getting that tweezer tops and a confirmation here. Now, normally I'd probably jump on something like this because that is technically what you would look for. Tweezer tops confirmation. That looks like a good opportunity if you are long Apple to do some covered calls or something like that. Well, keep this in mind. We've got earnings after the close today in Apple, Google. I mean, it is, if you don't have any money on the sidelines waiting to allocate for these earnings, you may have missed out, because today is the day for earnings, it seems like, because we've got Apple after the close. We've got Google after the close. I'm going to be GOOG. Come on, dyslexia. Failed. GOOG. All right, Google. Confirmation. This is a topping pattern. You know, at the end of the day, something like we were going to be talking, let me talk about a trade that I put on just to get this for kind of out before I start talking about those other ones. So with UPS, I played this to the upside. Now, they came out with forward guidance, all kinds of, or they didn't come out with forward guidance, and that was the big thing that caused them to sell off. Sorry. But basically, across the pond, they're expanding there. Now, DHL, if you've ever heard of those guys, the guys with the yellow trucks and the red lining, only times you guys ever really see those guys come into the picture is when you purchase something from overseas, maybe China, Alibaba. Usually it's getting shipped Alibaba through DHL or something like that. Well, UPS is starting to expand outside of the United States a little bit more aggressively. They've increased their European footprint by about 30%. That's pretty huge, more than expected. Here in the United States, 10% increase in domestics. They also talked about, the one thing that they really disappointed on was their profitability at the domestic level. So people were expecting to see more and more profits coming out of that as they streamline that process. Well, they didn't really do that, and they're struggling there. Most of that is having to do with higher fuel costs, I guess. But at the end of the day, they aren't able to streamline that process as much as people were expecting. And they didn't give any forward guidance. That was ultimately the thing that was the nail in the coffin today. Not really a nail, it's an opportunity as far as I'm concerned. But beat on revenues in Europe, beat on the revenues here in the United States, beat on the headline number, beat on the street, all of those things, but no forward guidance caused UPS at one point in time to be down almost 10%. Now, to me, that's an opportunity. They also still had volatility relatively high right after the data point. Now, we usually expect something like volatility crush, where you get something where the volatility really slams down right after earnings. Well, this is a situation what we've gotten here, where it hasn't crushed completely. So there's opportunity to take advantage of that high implied volatility. Plus, I think the market has completely overreacted here to the downside. Now, is it going to cover this gap here that we've talked about, something similar in Bitcoin? Well, we're right there. So yes, I do think that we might see some weakness here the next couple of days, but I'm looking for a bit of a dead cat bounce maybe before resuming, and volatility ultimately to really come out of this trade. So if the market really slams down to this Fibonacci, which is the extension from, the old high there, I should have some extensions on there. They might line up with the rest of the charts here, but I haven't done that at this point. I'm looking for this gap cover. And if it comes down to 178, that's a location that I would be happy to start getting involved in UPS. So with that said, whether or not you're looking at dollar cost averaging, if you're long UPS, this would be an opportunity to do that. Dollar cost averaging, maybe add some stock here. So with that said, would be like selling some cash secured puts. I'm not necessarily doing the cash secured puts because I'm trading this in my margin account. I'm putting this on as a trade, but the strike location and the volatility is leading me towards the selling of the puts, right? If I have high volatility and a bullish assumption, I have a bullish assumption based on everything but their forward guidance. I think they're going to do just fine. E-commerce is going through the roof. And people are starting to work from home as well. So I think that all of these things, when you're shipping, whether you're working for a business, if you're at home, that shipping's coming from your home. Now, those logistics are a lot more difficult to handle than something where UPS comes to your business and picks up everybody's packages, right? So that is a part of their headwinds as well. Having said that, UPS to the upside, all of those things I'm pretty bullish on. And with the strike location being right there at around 178 as a support level, that's what I'm looking for. So with an option strategy, I went into the August in UPS. It's near duration, 20 some odd days to go. I got that theta decay, right? Theta is going to really be working on my favor. And if volatility comes out, we know that volatility increases those premiums as volatility goes up. But as volatility goes down, those premiums decrease, even if the underlying doesn't move. So I want all of those things, working for me when I have a strategy on. And in this case, I have high volatility. I want to take advantage of high premiums. That means selling high, buying low. And if I want to sell high, I want theta to be on my side as well. So I want near duration because theta is more impactful the closer and closer you get to expiration. So sold the 180 puts in there, which means that if the underlying went below 180, that's where I'm willing to buy it. But I collected $1.61. So that drops my break even all the way down to 178.50. That's only 50 cents, slightly above that Fibonacci. And I got a 200-day moving average there. So I got a lot of little different support areas. I got the value area if that gap is covered. I've got a 200-day simple moving average here. That is a nice support level. And I've got this Fibonacci that lines up with the previous high that was back in October-ish. So we are going to find a little bit of support at those levels that would help me out. But if it goes down there to 178, I'd be happy to get long UPS for all of the things that is, working in their favor. Now we could also see something in FedEx. FedEx is actually getting crushed today because of the earnings that came out for for UPS. They didn't give forward guidance. You could see UPS was pretty much pretty benign after their number, but FedEx is an opportunity to take advantage of as well, not necessarily with high implied volatility. If you had a bullish directional assumption with this one, we can see that we already have low implied volatility. That would lead you towards buying options because that premium we know is extremely cheap in the option montage. Why? Because volatility is low. Volatility is the determining factor for those premiums, okay? Buy low, sell high, know the levers and pulleys, and that way you can turn that tables of probability into your favor there. All right, no questions so far. All right, we'll keep moving here. FedEx coming off, you might want to take advantage of that for a bullish assumption, buying options. I'm looking at the flip side where I have high implied volatility with a bullish assumption, so I'm selling options. So that's why I chose those puts rather than maybe a long call or a long call spread, folks. All right. And then there was a couple of other things that I wanted to run over real quick besides, let's get on with the earnings. So something with Google, earnings, like I said, a lot of these guys coming out with better than expected earnings, and we are seeing them show some weakness. Another thing to talk about here is market maker moves in some of these things to keep an eye on. If you haven't watched any of my videos on earnings yet, you should. But the other thing is, when we're looking at earnings, something to keep an eye on here is at the top of a move here in the earnings, you want to look here at the market maker move. That is the expected move for the underlying. So if you are selling options for that high implied volatility, you want to at least make sure that you are $86 away from where the underlying is trading. Now, if you guys watch those videos, like I said, that's right usually around that 16 delta. And we talk about when, where, and why we put those on around that. But I'm going to be looking at Google, Apple for earnings after the close. We also got Starbucks. Starbucks already probably making some moves. They have kind of hinted that their app, if you guys remember, a couple of years ago, they started doing these apps where you could call in, order your drink, pick it up as you walked in. You never even went to the counter or even talked to anybody. Well, that during this pandemic was a huge winner for them, and they've talked about that already. So Starbucks, I would likely be playing it to the upside, despite the fact that I don't really eat at Starbucks. And Visa having some weakness today, as the banks are going to be see some weakness. Even I think some of these institutional companies are going to see some weakness, folks. Why? Because interest rates are going to remain relatively low for the foreseeable future. They aren't going to stop asset buying, all right? We've already seen the UK say they're not going to stop asset buying. Well, if that's not a clue, I don't know what is. Remember, we always are talking about the race to debase. Well, this is one of those ways to do that, suppressing interest rates down by buying bonds. Remember, when you buy bonds and that price goes up, that means interest rates are going down. So they are completely inversely correlated there. So with that said, I think that if interest rates are going to remain relatively low, that these companies that make all their money off of the interest rate or the interest rate spread, right, are going to have a difficult time making a lot of money. When the interest rates are up about 5-6%, you know, they can gap it up to 7-8%. But when they're suppressed at 0.5% or something like that, scalping multiple percentage points over that number makes it very difficult. And I think that things like Visa, MasterCard, Morgan Stanley, all of those guys are going to start seeing some weakness. Institutional will do a little bit better than something like the Bank of America's, but you guys already know I've got bearish trades on for some of these regional banks rather than the institutional banks or retail banks. All right, so that's it. That's all I've done is added that UPS. I'm going to be looking at, like I said, Google, Apple, Starbucks after close, Microsoft's after close, Visa after the close today. And then in the morning, we've got all kinds we got eBay, or sorry, not eBay. We got Boeing, McDonald's, Spotify, Pfizer, and Waste Management. I'm not going to play probably Waste Management or Investco, which is also after, or sorry, in the morning or something like that. Anyway, I'm going to look at Google, Apple, Starbucks, Microsoft, and Visa, but don't have anything that's going to be a game time decision on what I'm doing there. So I'll try and pop on here a little bit later on today or throw it out there in Twitter land if you guys are paying attention there. And that's all I got for you guys. If you don't have any questions, comments, or anything else over there in the side, then I'll start moving on. Make sure you guys hit that subscribe button so that you guys get notifications when I pop in here unannounced, or if you forget about the webinars that we do on Thursday, make sure you got those notifications so you can get that. And finally, you know what? If you can't smash that, take that or take it easy. Bye for now.